While the absence of a rate cut in the policy is surprising, the RBI has at least provided a clear logic and a rationale behind it. It sees the disruption in economic activity because of the demonetization drive as transitory and expects it to sort of improve going into the coming calendar year. On the other hand, it sees a lot of risks on the inflation front coming from the global side as well as from domestic factors like firming agriculture prices in a number of categories, some pressure on services prices because of the pay commission hike and the OROP and so on. I think it's a policy that's been taken in the middle of a large amount of uncertainty. And some of the uncertainties that the RBI faces, it hasn't sort of recognized in the policy statements, and rightly so perhaps, because, for instance, there is a lot of uncertainty about the way the currency will move given a rate hike that is impending from the US Fed. So given these various uncertainties and its sort of take on inflation and the transitory nature of growth, they have decided to stay on hold. What is somewhat contradictory, though, that they have indeed revised the GDP growth number, GVA to be specific, quite considerably from 7.6 to 7.1%. That suggests a deceleration in the second half. That would have sort of warranted a rate response, but clearly the inflation concern has got the better of it. There is very little discussion on the rollback of the extraordinary liquidity measures that were taken, the increase in CRR, the introduction of the MSS. So banks will still be left guessing as to when some of the impounded liquidity will be released and sucked up through interest-bearing instruments. So that is a bit of a disappointment. Going forward, I think there is, once the uncertainty sort of clear up, and I think there is concentrated uncertainty in December, and some clarity emerges on the actual impact of demonetization and the relief from remonetization, there could be a change in stance and perhaps another rate cut is due. But going forward, given both the way the US rate cycle is likely to move, which is clearly up and perhaps at a faster pace than we had anticipated earlier, and the fact that inflation risks are growing on the back of both rising crude prices that the credit policy mentions, and also because of things like rising base metal prices on expectations of a large fiscal stimulus in the US, I think the room for rate cuts going forward is clearly very limited.